Are you able now to hear me now? Chat and say yes, that you're able to hear me now. Are you able to hear me so that we can start? You chat yes, that you're able to hear me now. Yes, you're able to hear me now. Good. Thank you. So let's start. Okay, I hope you're able now to hear me. I hope you're able to hear me now. Yes, so let's start. So yesterday we were doing a question. On published accounts. We were doing a question on published accounts, and we had done part one of that question. We had done part one of the question, and so we want to continue. Not part one, sorry. We had done the working for note one. We had done the workings for note number one, and that's what we want to continue with now. We want to continue with that working now. So let's continue with the working. But maybe before we continue, let us read the question again. Let us read that question again so that we understand it properly. Now. The question was for November 2015. Question number one. Maybe we can read it again. It said, Dollar Limited, a quoted company dealing in household goods, had prepared the following trial balance as at 31st of December 2014. In the trial balance, you are given revenue, interest paid, then you are given purchases, distribution cost, administrative expenses, you are given interim dividends paid, you are given inventory as at 1st of January 2014. You are given trade receivables and payables. Then you are given cash and cash equivalent. Then you are given ordinary shares. Let me roll the question. After ordinary shares, you are given share premium, general reserve, retained earnings. Then you are given 4% loan stock, a loan. Then you are given land and buildings. You are given the cost for the land, it's 60. Then you are given for the boat. Then you are given accumulated depreciation. Then you are given plant and equipment at cost. Then you are given accumulated depreciation. Then you are given investment property. Then you are given, that is at 1st of January 2014. Then you are given rental income. Then you are given proceeds from sale of investment. Then we now go to the additional information. Number one said, the closing inventory as at 31st of December 2014 amounted to 388 million at cost. However, shortly after the year end, some inventory with a cost of 15 million was sold for 8 million. Number two, land and buildings were revalued. At 1st January 2014 to 800, including land, shillings 100 million. The building had a remaining useful life of 40 years. Number three, the income tax liability was estimated to be 20 million. Deferred tax was to be provided at 7 million. Number 4, during the year, the company sold some equipment which had cost 15 million with an accumulated depreciation as at 1st of January 2014 of 3 million. The item of plant was also estimated to be impaired by shillings 4 million during the year. Number 5, depreciation rate as per the company's policies are as follows. Buildings, we depreciate them over the useful life. Next, plant and equipment over 20%, reducing balance. I move the question, I roll the question. Then next, we are told the company's accounting policy is to charge a full year's depreciation in the year of purchase, in the year of asset purchase, and none in the year of disposal. The company treats depreciation of plant and equipment as a cost of sales, and on land and buildings as an administrative expense. Number 6, Dollar Limited values investment property at fair value. The fair value of the investment property as at 31st of December 2014 was 586 million. Good. Number 7, during the year, the company made a 1-for-3 bonus issue capitalizing general reserve. This transaction has not been accounted for. Then you are required prepare in a format suitable for publication the following financial statements for Dollar Limited for the year ended 31st of December 2014. Number 1, income statement. Number 2, statement of changes in equity. Number 3, statement of financial position. Then they told you notes to the accounts are not required. Notes to the accounts are not required. Good. So what we did yesterday, we did up to note number 1. We did up to note number 1. We did up to note number 1. Somebody is asking which question. We are doing a November 2015. We are doing a November 2015 question. That is financial reporting, November 2015. So if I take you back to where we started, that's note number 1, just to connect, so that we connect with what we want to do today for the remaining of the workings. Number 1, you remember, told us that by the end of the year, listen, I just want to remind you, note number 1 told us by the end of the year, the company had inventory amounting to 388 million at cost. However, shortly after the year end, some inventory with a cost of 15 million were valued or were sold for 8 million. You remember we said yesterday that it is required that stocks should always be valued at the lower of cost and net realizable value. Stocks should always be valued at the lower of cost and net realizable value. Okay, so we said stocks should be valued at the lower of cost and net realizable value. That's what we were saying. Then we said, now, if the cost had 388 million, somebody is saying the projection is not clear. Is it clear to other people? Is the projection a bit clear to the other people? It's not clear to everybody. Are the other people able to see? Are the other people able to see the projection? Somebody is saying it's not clear. Are the other people able to read? Yes, it's clear. There you can see now. Somebody says it's clear on their part. One person says the projection is not clear. It's clear. Kwa hivyo, maybe the Wi-Fi strength again on your part is not strong. Okay? Sawa. So you will have to bear with us. The others are saying it's clear. Okay, good. So let's go back. Number 1. The closing inventory as at 31st of December 2014 amounted to 388 million at cost. However, shortly after the year end, some inventory which had cost 15 million was sold for 8 million. You remember we said yesterday that stocks should be valued. That's what we talked about yesterday, that stocks should be valued at the lower of cost and net realizable value. So out of these 388 stock that you have, one part of it, which costed 15 million, will be sold or has been sold for 8 million. And by the end of the year, because it had not been sold, then it was part of the closing stock. That's what we were saying yesterday. I'm not repeating everything. We discussed everything yesterday, you remember. So we said the first thing to do, take that 388, remove the stock of 15, remain with the stock that does not have issues. Remain with the stock that does not have issues, which according to my workings, I can see we remained with a stock without issue of 373. Then tukasema, yes, there is this bunch which had a cost of 15, but it has a net realizable value of 8. Tukasema, stock should always be valued at the lower of cost and net realizable value. So when I was explaining that, you remember I gave you the details, and so we are saying now we had to value that stock not at 15, but we had to value it at 8. So we added that 8 million. You remember we added that 8 million to the 373. So we got the true closing stock of this company. The true closing stock of this company will be 381, will be that amount of 381. Good. From there, I think that was the only working. We had to do, or we had done. So the only thing now we can do is to go to note number 2 and deal with it accordingly. So let's go to note number 2 and deal with it accordingly now. Note number 2, what is it testing us on? I want to discuss note 2 now. Note number 2 says, land and buildings were revalued. Land and buildings were revalued on 1st January 2014 to 800. That is land and buildings, mark you, including land for 100 million. Then they are telling you the building had a remaining useful life of 40 years. So there are two things they are testing you on. For note number 2, there are two things they are testing you on. One is to know what is the gain or loss on revaluation of the building and the land. They have separated. Once you determine the gain or loss on revaluation, the second thing the examiner is testing you there is the determination of the depreciation charge on the building. Do not forget that this land and buildings were revalued on 1st January, not by 31st December, by 1st January 2014. That means they were revalued at the beginning of this year. Get that point clearly. Both of them were revalued to 800. Land to 100. Meaning the building, I hope you are listening, the building was revalued by the beginning of this year to an amount of 700. Good. But we need to know what is the gain or loss on revaluation of the land and of the building. So if I go back to the trial balance, you can see the trial balance somewhere in the middle. You are given the value of the land and buildings, you are given the cost, and you are given the accumulated depreciation. In bracket, we are told the value of the land was 60 million. Of course, you know, listen, we don't depreciate the land. We normally don't depreciate land. From the additional information, the examiner told us, listen carefully, that both of them were revalued to 800. Okay? Then in bracket wakasema land was 100 million. So if land was revalued to 100 million, and now I can see it as a value of 60 million, then automatically it means the land on its own made a gain of 40 million. Made a gain of 40 million. So let us put down that first. The determination of the gain on revaluation of the land. Determination, andika somewhere determination of the gain or loss on revaluation. Ama tu andika gain on revaluation of building, no, land. Gain on revaluation of land. That one is clear. We revalued it at 100 million while it had a book value of 60 million. It had a book value of 60. So it is obvious that land on its own is giving us a gain of how much? 40 million. Land on its own is giving us a gain of 40 million. Good. So finish. We go to the next one now. Now I want to project back the question so that you calculate for me how much is the gain or loss on revaluation of how much is the gain or loss on revaluation of the building. Let me project the question again. Look at that trial balance. Remember, listen, note number 2 told us, I hope you are getting, note number 2 told us that both land and buildings were revalued at 800. Then in bracket wakasema the land was valued at 100 million. Then I'm saying it obviously tells you that the building was revalued at 700. So the question is this: by how much? What is the gain or loss on revaluation of the building? Look at the trial balance and calculate for me by the beginning of this year when they were revaluing the land and buildings. How much therefore by the beginning of this year is the gain or loss on revaluation of the building? For the land we have already done. But I want you to calculate for me and tell me in the chart what is the gain or loss on revaluation of the building. Get me the gain or loss on revaluation of the building. The gain or loss on revaluation of the building. By 380. Somebody is saying 380. I am saying, listen, 380, ukiangalia kwa trial balance, that's the value of both. Where? Ukiangalia kwa trial balance, land and building, both had a cost of 380. I hope it's not the one you are confusing. That's what I'm saying. I hope it's not the one you are confusing. I'm saying, I hope it's not the one you are confusing. Me, I want to give me the gain or loss on revaluation of the building. And I'm saying, be very careful. Kindly show note 2. I have said, note number 2, let me repeat it for you. Note number 2 said, both land and buildings were revalued at 800. That's what note 2 told us. Then in bracket, we were told land was revalued at 100. Then I concluded from note 2 that the building on its own was revalued at 700. So the question is this: at what was the gain or loss on revaluation of the building? What's the gain or loss on revaluation of the building? Okay. Now, I want you to follow keenly for me now. Listen. If you look at the trial balance, look at that trial balance, the cost of the building, listen carefully. The cost of the building is 380 minus, listen, 380 minus 60. That gives me 320. I want you to listen carefully. The cost of the building is 380 minus 60. Why? Because both land and buildings had a cost of 380. Now listen. Meaning the building had a cost of 320. But the key issue is this. Yes, by the beginning of this year, when they were revaluing, yes, the building had a cost of 320. Listen carefully. But the examiner also wanted you to know, you normally don't compare, listen, you don't compare the cost of the asset with its fair value. No. You compare the net book value of the asset. If you looked at the trial balance, which I hope you looked at, if you looked at that trial balance, there was an accumulated depreciation. And obviously, you know, any accumulated depreciation in the trial balance, normally represents the accumulated depreciation by the beginning of the year. Get my point here, where the tricky was. So yes, the cost of the building was 320, but it had an accumulated depreciation of how much? By the beginning, 64. So it means, therefore, if the accumulated depreciation of the building, this is accumulated depreciation of the building, was 64, what must have been the net book value? What must have been the net book value by the beginning of the year? And that is where the tricky was. The examiner wanted you to confuse and take the 700 yes for the building, then you compare with 320. I'm getting why people are saying 380. Now I am getting where people are saying 380. That's wrong. The trick here is, and I'm saying, the examiner wanted you to know that you normally compare the net book value, not the cost, the net book value with its fair value, So if I take a calculator and I take 320 minus 64, that gives me 250. That gives me 256. 256 is the book value of the asset by the time it was being revalued. But it was revalued to how much? That is the fair value now, 700. So there was a gain of how much? Minus from 700. That is 444. I think I saw somebody with it. I think I saw somebody with 444. Yes, there was two people. Yes, good. 2 people. So that was the small trick. So let's put down that working now. So andika somewhere determination. Put it down as a working. Determination of the gain. Determination of the gain. Andika determination of the gain. Determination of the gain on revaluation of the building. That is determination of the gain on revaluation of the building. Then you come and say this below that, andika net book value of the building. Net book value of the building. Net book value of the building. Net book value of the building as at 1st January 2014. Net book value of the building as at 1st January 2014. So you can come and say net book value is equals to cost minus accumulated depreciation. Cost minus accumulated depreciation. And we are seeing the cost was 320. The cost of the building was 320. That's what we have already agreed. Minus, that is 320 million, minus its accumulated depreciation of 64 million. We have agreed that it had a book value of 256 million. Good. So that's where the examiner wanted you to know. That's 256 million. Once you know the book value, then you compare that with the fair value. So we come and now say here gain on revaluation of building. Gain on revaluation of building. So put it as 700 million minus 256 million, and that will give you 444 million. We have agreed that. So on the land, there is a gain of 40 million. On the building, there is a gain of 444 million. Good. So finish, we are through with the revaluation. I am not through with that note. Don't forget the question told you, listen, don't forget the question told you that the building had a remaining useful life of 40 years. Get the point there? The building had a remaining useful life of 40 years. Listen, so you need to know by how much are we going to depreciate it by. By how much are we going to depreciate it? The other thing, listen everybody, the other thing I wanted you to notice, or I want you to notice, is this. If the building was revalued at the end of the year, same everything, but at the end of the year, then it means, get my point, it means that this year you will not have depreciated the building. If it was revalued by the end of the year at 700, then you will start depreciating it from next year on 700. But the trick again in this question was, this asset called the building, which was revalued by the beginning of the year at how much? At 700 million. Then at the same beginning of the year, not at the end, at the beginning of the year, that asset had a remaining useful life of 40 years. I want you to understand that very clearly, because there are some questions in your past papers where you revalue assets at the end of the year. And if you are revaluing them at the end of the year, then for the current year, you don't depreciate it on that fair value. You depreciate it on the old book value. But here is a case where the asset was not revalued. Listen, the asset was not revalued at the end of the year. The asset was revalued at the beginning of the year. So it is obvious that it is from now on that you will start depreciating it on 700. That you will start depreciating on 700. We are not dealing with plant. We are dealing with land and building. Note number 2, Mr. Who, or who is it? Hillary. Note number 2 is not touching anything to do with plant. Maybe another note will touch it. But we are dealing with note 2. I hope you are getting. We are dealing with note number 2. Let me take you back there. We are dealing with note 2. Note number 3. We are dealing with note number 2. And note number 2 said, land and buildings were revalued on 1st January 2014 to shillings 800 million, including land to 100 million. The building have a remaining useful life of 40 years. So that note does not touch anywhere anything to do with the plant. I hope Sang you are getting. We are only dealing with note 2, that is on the land and building. And we have already concluded land was gaining 40. I hope you followed there. Then the issue was on the building. The issue was on the building, in the sense that the building was revalued to 700. That's obvious. But to get the gain or loss on the revaluation of the building, the examiner wanted you to remember that building is being depreciated. In the trial balance, we saw the building had a cost of 320. And at the same time, it had an accumulated depreciation of 64. So you had to first ask yourself, what is the net book value of the building by the beginning of this year? And we saw it as 256. Once we knew the book value of the building was 256 by the beginning, then to Kaona, at the same beginning, the company revalued it to 700. The company revalued the buildings to 700. And therefore, at the beginning of this year, that building made a gain of 444. That's how we are doing it. Then I'm saying, once you are through with the gain or loss on revaluation, the examiner also wanted you to return to know that you are going to depreciate the building. And that's what I was talking about, where the trick sometimes you find it. I have said, there are times you are given a question where the asset was revalued at the end, listen, at the end of the year. So this year, you will not depreciate it on 700. If the revaluation was done at the end, you will depreciate it in normally at cost, whatever, blah, blah, blah. But now that the asset, listen, now that the asset was revalued at the beginning of the year to how much? 700, then it means from now onwards, you will be depreciating that asset on its fair value. So what we were trying to calculate is how much shall we charge as depreciation on the building this year. So I hope, Hillary, you have understood. Is it Hillary Sang? I hope you have understood what we are saying. Are you okay now? I hope, Hillary, you have understood. Meanwhile, for the others, let's compute the depreciation. For the others, let's compute depreciation on the building. So put down the working somewhere, put it down and say depreciation charge. Depreciation charge on building. Depreciation charge on building. And so we are taking, that is 700 million. We divide that by 40 years. So it means every year, what shall I be charging? I take that 700, I divide by 40 years. I am getting a charge of 17.5 million every year. Good. Sang, as I said, ameelewa. Good. So that's all for note number 2. Let's go to number 3 and see what is it that they are testing. Note 4. I think it's note 2 or 3. Let's see. We are through with note 2 now. Let's go to note 4, note 3. we want to deal with one item after the other. Kama kuna workings, we do the workings for it. Kama kuna workings, we do the workings for it. That's what we want to do now. Okay, so we are reading note number 3 now. We are reading note number 3. We want to know what is it that it's testing on. What is it that they are testing us on? And note number 3 says the income tax liability was estimated at 20 million. That one has no issues. We just charge 20 million. Then they are saying deferred tax to be provided at 7 million. Good. So which means we need to determine what is the charge for the year for deferred tax. We need to determine what is the charge for the year for deferred tax. So open an account called deferred tax. Open an account called deferred tax. Let's go to the trial balance and bring down the balance that was there by the beginning. They are telling us, that note is telling us, deferred tax to be provided at 7 million. In other words, to be maintained at 7 million. But what was the amount originally? What was the amount originally? That's what we want to know now. So from this trial balance, how much was the amount of the deferred tax? Oh, from this trial balance, it seems like I can't see anything called deferred tax. Good. From this trial balance, I can't see anything called deferred tax. Good. So it means there was no opening balance. Just put a 0. No problem. Just come and say 0. It could have been 5, 2 million, 1 million. It doesn't matter. But bring it down. Now we are being told to maintain it at 7 million. That means that's what we are carrying down. Balance carry down, 7 million. Then it is the balancing figure in this account. It is the balancing figure in this account that you have to charge to the profit and loss. It is the balancing figure in this account that you have to charge to the profit and loss. Okay, that's what we are saying. So which is that amount? Of course, the same, 7 million. And you come and say here to the P&L account, this is as a balancing figure, mark you, as a balancing figure, 7 million. That's what we are charging in the P&L account. I hope you remember the argument for deferred tax. We don't have to go back. We discussed it in details. We don't have to go back. Remember, you have credited this account called deferred tax. You have credited the account called deferred tax, which automatically means you are going to debit P&L. I told you last time, corporation tax is normally debited in the P&L account, which we were also calling current tax. It's always debited. So if I'm going to debit again by another 7 million, that P&L account, if I'm going to debit P&L account by another 7 million, then we said that will increase the corporation tax. So for this question, we are crediting deferred tax, which automatically means you are going to debit P&L account. You remember we were following the double entry to guide us. So just in summary, we remember we said you are now crediting this account called deferred tax. You must go and debit P&L. When you are debiting P&L and yet there is another debit in the P&L account for tax, current tax, then we said you are increasing. When you debit an account which has already another debit, you are increasing the debit. Good. That's all. So for note number 3, we are through. Let's go to number 4 and see what is the examiner testing us on that note number 4. Number 4, they are saying, number 4, during the year, the company sold an equipment which had a cost of 15 million with an accumulated depreciation as at 1st of January 2014 of 3 million. An item of plant was also estimated to be impaired by 4 million. Good. What they are saying is this. Here, they are testing you on disposal of an asset. This is something you must have done in section 1, financial accounting. That is how to determine. Listen, whenever an asset is sold, you as a company, you had to determine the gain or loss on disposal. Listen, and I told you yesterday when we were reading this question that when you are determining the gain or loss on disposal of a fixed asset, there are normally several steps that are normally followed, which I hope you still remember them when you are doing this topic of depreciation in section 1. So I want us to go through those steps so that we know whether we sold this equipment at a gain or loss. So according to that note, they are calling it equipment. But when you look at the trial balance, it is being called plant and equipment. From the trial balance, they are calling it plant and equipment. So you also know, whenever an asset is disposed and you have to determine the gain or loss on disposal, there are several accounts you had to open. One of the accounts you had to open was the asset account. So let's do it. Open an account called plant and equipment. That's how they are calling it, plant and equipment. Another account you needed to open, or you were opening, if you remember, was an account called provision for depreciation. If you remember, provision for depreciation. Another account used to open in the determination of the gain or loss on disposal was an account used to call disposal account. Disposal account. Good. So, but before you go to the double entries, you know you had to bring down the balances. That one somebody should not forget. So let's go bring down the value of the plant and equipment. That means the cost. Balance brought down. Then we shall also bring down the accumulated depreciation. I am hoping these are things you can remember, because we don't teach depreciation in this level. Here the examiner was testing you what you did in foundations of accounting, that is financial accounting. Good. So let's go back and bring down the balances first before we go through the steps of disposal. So from this trial balance, I can see the cost of the plant and equipment is 256. Bring it down. That is 258. That was the cost of the plant and equipment. We also bring down its accumulated depreciation, which according to the same trial balance, that plant and equipment had an accumulated depreciation of 126. Bring it down. 126. Good. I don't want to ask you questions, but otherwise I should have asked you that what are the steps you used to follow whenever an asset was disposed. I should ask you, what are the assets, what are the steps that should be normally be followed whenever an asset is disposed? Whenever an asset is disposed, what were the steps you used to follow? Normally, there used to be 4 steps. For you to get the gain or loss on disposal of an asset, there were 4 steps that you had to follow in order to determine the gain or loss on disposal. Number 1, I hope you remember it. Now that you have sold the asset, do you need to keep it still in the asset account? No. It's no longer an asset in the company. It has been disposed. So we are saying the first thing you must do, listen, Whenever you had to sell an asset, the first thing you had to do was to transfer, listen, to transfer the cost price of the asset, the cost price of the asset. From where? From the asset account to the disposal account. You had to transfer the cost price of the asset from the asset account to the disposal account. So this question told us under note number 2 that the asset called plant and equipment that we sold had a cost of how much? That's what we want to go to, that note number 4. Wamesema that plant and equipment had a cost of 15 million. So let's use it as step number 1, which says transfer the cost price of the asset sold from the asset account to the disposal account. So remove it from the asset. How? By crediting the asset and debiting disposal by 15 million, and you debit disposal, and you come and see your plant and equipment by 15 million. That was your step number 1. That was your step number 1, which said transfer the cost price of the asset sold from the asset account to the disposal account. How? You credit the asset and you debit disposal. You credit the asset and you debit disposal. Good. That's number 1. Number 2. Remember, you have been depreciating this asset every year. For how many years you have used it, it doesn't matter. But you have been depreciating it, and carrying down the balance together with the other assets. You have been depreciating it together with the other assets and carrying down the balance. So out of this 126, which is the accumulated, we need to ask ourselves how much out of that is the depreciation of the asset sold. Why? Because once you sell the asset, you don't need to keep its depreciation again in the books. No. The way you have removed the cost, you also remove its accumulated depreciation. That is our step number 2 that says transfer the accumulated depreciation of the asset sold from the provision for depreciation to the disposal account. Transfer the accumulated depreciation of the asset sold from the provision for depreciation to the disposal account. This question had computed for you. Listen, this question had computed for you what was the accumulated depreciation as at the date of disposal. Some questions don't give you the accumulated. You know how to compute it. You had to go back to the question. If they had not given you, you had to go back to the question and ask yourself, how long have we used it? And for those years, how much have we been depreciating? Then you had to ask yourself, were you using straight line method or reducing balance method? Whichever the way, you had to compute the accumulated depreciation of the asset sold. For this question, that note number 4 told us that the asset which was sold had an accumulated depreciation of 3 million. Good. So let's use that as our step number 2, which says transfer the accumulated depreciation of the asset sold from the provision for depreciation to the disposal account. So remove it by debiting provision, and you credit disposal by 3 million. And you come and credit disposal, and you come and see a provision for depreciation. That is 3 million. That was always your step number 2, which said transfer the accumulated depreciation of the asset sold, transfer the accumulated depreciation of the asset sold from the provision for depreciation to the disposal account. Transfer the accumulated depreciation of the asset sold from the provision for depreciation to the disposal account. Good. So let's go to step number 3. Now you know step 2. Step 3, you remember, I am just reminding you. Otherwise, I should be the one asking you these steps. Step number 3 used to say, record the cash received on disposal. Record the cash received on disposal. From this question, in the trial balance, I remember, we were given, in the trial balance, I hope you can see the last item up there. We were told proceeds from the sale of equipment. From the trial balance up there, I hope you can see they are giving us proceeds from sale of equipment. So we sold the equipment for 7 million. Of course, the double entry is you normally debit bank and you credit disposal. So come and see your cash or bank. 7 million. That is always step number 3. Record the cash received on disposal. That is step 3. Step 4 and the last one. Step 4 and the last one is to determine the gain or loss on disposal as a balancing figure in the disposal account. You had to determine the balance in the disposal account to be either the gain or loss on disposal. From this disposal account, I can see the balancing figure is on the credit side, and therefore we come and see a P&L account as a balancing figure. That looks like how much? 5 million. That is 5 million. That is what goes to the P&L account. Question to you is this. Question to you now. Is that 5 million a gain or loss? Is that 5 million a gain or loss to the company? Just to see whether you remember what you used to do. That 5 million, were you considering it as a gain or loss? Somebody tell us, were you considering the 5 million as a gain or loss? That's a loss. Okay, good. Somebody else, I don't know whether he's right. Loss. Sawa. That's true. One way to know it, in a simple way, listen, the simplest way to know it, higher. Somebody else says it's a gain. I thought everybody would give us the same answer. You can now see, people are giving different answers now. I wish we had even time. I would have asked you those 3 accounting entries. Step 1, step 2, and step 3, I should have asked you. Because this is something you did. Now listen. The quickest way to know is this. You are crediting this account. You are crediting this account by 5 million. It is obvious. It is obvious. You will go and debit P&L. You will go and debit P&L. Anything debited in the P&L cannot be a gain. It must be a loss. If the difference was on the debit side here, in the account called disposal, if the difference was on the debit side, then it means you would have been debiting disposal, then you would have credited P&L. You know, any gain, it doesn't matter which one, is always a credit balance, is always a credit balance. And so we are saying, if the difference was on the debit side, then it means you have to go and credit P&L. That will be a gain. So one way to know whether it's a gain or loss is to look at the double entry. The other way to know is this. You will say, this machine costed us 15 million when we were buying it. By the time we were selling it, it had already lost value through depreciation by how much? By 3 million. So if it costed 15 and it had already been depreciated by 3 million, it means By the time we were disposing that asset, it had a book value of 12. That was the value of the asset. But we sold it for how much? We sold it for 7. So if it had a book value of 12 and we sold it for 7, then we must have sold it at a loss. We sold it for less than its value. That means it's a loss. That's another way of knowing it. Good. Now, listen carefully. And this is also critical. Once you are through, I hope you are listening. Once you are through with the asset sold, those 4 steps. Once you are through with those 4 steps, you did not stop there. Get the point? Once you are through with those 4 steps, you are not stopping there. Once you are through with those 4 steps, just a minute. Okay, so I was saying this, listen. Step number 1, transfer the cost price of the asset sold. That one we have done. From the asset to the disposal. Step 2, I have said. Step 2, transfer the accumulated depreciation of the asset sold from the asset account to the disposal account. That one we have done. That 3 million. Step 3, record the cash received on disposal. We have done. Step 4, determine the gain or loss on disposal. 5 million. Now, listen. Once you are through, even in section 1, once you are through with the asset sold, you had to, listen, you had to depreciate the assets that were still remaining. I hope you remember that. Once you were through with the assets sold, you had to depreciate the assets still remaining. So you had to go back to the motor vehicle account or to the furniture account or to the plant and equipment account and ask yourself, how much are the assets still remaining? We depreciate them. So from this account of the plant and equipment, I come and get the balance carried down. Once I am through with the assets sold, you must depreciate the ones remaining. How much are remaining? That is 258. I minus 15. And that gives me a carry down of 243. 243. That is the assets that are remaining. Listen. Then you had to depreciate them. Get the charge for the year for them. That charge, listen, you have to debit it in the P&L account and you have to credit this account called provision for depreciation. How much is the depreciation charge? Listen now. To get the charge for the year, for the remaining ones, now you have to go back to the question and ask yourself, what is the policy of depreciation? Is it straight line method or is it reducing balance method? That's what I'm saying. That once you went through with the assets disposed, you had to depreciate the ones remaining. So get the ones remaining in the motor vehicle account or in the furniture account. In our case, it's plant and equipment, which I can see it is 243. Then now I go back to the question. I need to know what was the policy of depreciating these assets. Note number 5 says, depreciation rates as per the company's policy are as follows. Buildings over its useful life, plant and equipment, reducing balance method. Reducing balance. Let me roll the question. After that, it goes on to say, the company's policy is to charge a full year's depreciation in the year of asset purchase and none in the year of disposal. The company treats depreciation on plant and equipment as a cost of sale and on land and buildings as an administrative expense. So before we classify that charge, we need to know how much it is. Note number 5 tells me, listen, we are depreciating plant and equipment at 20% reducing balance. 20% reducing balance. Listen, 20% reducing balance. Let me simplify the question first. Let me simplify the question first. If the examiner had said 20% straight line, then you know. If it's 20% straight line, you just need the cost of the asset. For straight line method, you just need a percentage on cost. Listen, so I would have just taken, listen, I would have just taken 20% of the 243. 243 are the assets remaining. So I would have taken 20% of that. Whatever I would have got, I would have brought it here as the charge for the year in the account called provision for depreciation. That is, if the method had been 20% on cost. Why? Because this 243 is the cost of the asset. But our question is not saying we use 20% on cost. It is saying 20% reducing balance. Listen, and you know, reducing balance says you charge during the year, you get the charge as a percentage of the net book value. Listen, it's true assets remaining have a cost of 243, but I don't need their cost. What I need is their book values. Once I get their net book value, then now I can take 20% of that. Because of time and whatever, I don't have time to ask you, but I would believe that you know how you would get the 20% reducing. That's what I'm believing. Because I have no time to ask. I have told you. Because we are using reducing balance method, it is you take 20% of the book value of the assets remaining. Yes, those remaining have a cost of 243. Listen, so if the asset had a cost of 243, listen, I need to minus their accumulated depreciation. Once I minus the accumulated depreciation for them, which ones? These ones. Then I'll get the net book value. Once I get that net book value, now I can take 20% of it. So my question to you now is this. How much am I going to deduct as the accumulated depreciation? Give me the answer. How much am I going to deduct as the accumulated depreciation? Give me the answer. Very fast. Yes, I know the assets remaining have a cost of 243. The method does not require me to use straight line. No, so I don't need that 243. What I need is their book value. To get net book value, we have said you take the cost minus accumulated depreciation. So I know the cost as 243, but I want to know what is their accumulated depreciation. Very good. Guys are getting. That's very good. I thought I'll have an issue there, but guys are getting. Thank you. Now listen. So to get the accumulated, listen, to get the accumulated depreciation of the ones remaining, this is how you argue. You normally say, listen, this accumulated balance brought down, which is 126. That balance brought down of 126, it is the accumulated. Listen, that 126 represents the accumulated depreciation of all the assets that were there by the beginning. You can see the amount in the asset account 258. So all the 258 had an accumulated depreciation of 126. Listen, but out of the 258 cost, we sold one costing 15. This one that is costing 15, listen, had its accumulated depreciation of 3. Listen, so if 126 is the depreciation of all of them, including the depreciation of the one sold, then it means if I want the depreciation of only those remaining, yes, I know the cost of the ones remaining is 243. But because I don't need the cost, I need the book value, I had to also get the net book value of the ones remaining. I had to get the net book value of the ones remaining. And to get the net book value of the ones remaining, we are now saying I take the accumulated for all of them, then from that amount, if I take 3 million and I remove it from 126, if I take 3 million and I remove it from 126, that tells me, that leaves me with an amount of 123. What does that 123 represents? It represents the depreciation of the assets not yet sold. Why? Because 126 is for all of them. But out of that 126, 3 million is for the assets sold. So if I take 3 million and I remove it from 126, I'll be left with 123, which remains or becomes the depreciation of the ones still, the depreciation, the accumulated depreciation of the ones still remaining. Now I know the cost. I know the cost as 243 Palicini. I minus that 123. That will now give me the book value, which looks like, listen, which looks like now, Apocini, the cost was 243, the accumulated is 123, that looks like a net book value of 120, if I'm correct, 120. It is on that 120 now that you charge 20%. So that is normally a tricky item whenever there is a disposal of an asset. You remember it used to be a bit tricky when you are depreciating. But let's put down the workings now. Let's put down the workings. Andika somewhere below there. Put down this working, sema hivi. Determination of the depreciation charge for the year. Put down the workings. Determination of the depreciation charge for the year for the assets still remaining. The depreciation charge for the determination of the depreciation charge for the year for the assets still remaining. Determination of the depreciation charge for the year for the assets still remaining. Then you come and say number 1, accumulated. Number 1, accumulated depreciation of the assets still remaining. Accumulated depreciation of the assets still remaining. We said all the ones that were there by the beginning had a value of 126 million. If I remove 3 million, that will leave me with 123 being the accumulated depreciation of the assets still remaining. That's number 1. Number two, useme determination. Number two, determination of the net book value. Determination of the net book value. Determination of the net book value. Determination of the net book value of the assets still remaining. Determination of the net book value of the assets still remaining. So you come and say your net book value is equals to cost minus what? Accumulated depreciation. Cost minus accumulated depreciation. We know the cost as 243. That one we picked it from the asset account. We minus now the accumulated 123, which we have just computed under step 1. That's working note 1. Good. That gives me 120 million. That gives me 120 million. Good. Once I now know the book value, now I can do number 3, which is now what we can say determination of the depreciation charge. We can now say, yeah, depreciation charge for the year. Depreciation charge for the year. We take that 20% that we were told at 120 million. That looks like exactly 24 million. That looks like exactly 24 million. Good. So that is it now. That is it. Now we can take it back. If you're through with the copying, we can now take that 24 back to the account. So when it comes to disposal of assets, you have to be very careful. Especially sometimes you are given in the question on published accounts where an asset is disposed. That process of determining the gain or loss on disposal, one should be very conversant with. Okay, now that we have got the charge, which is 24, take it now to the account called provision. We had already opened it. Take it now to the account called provision for depreciation, and that one tumepata as 24. So we put it as 24 now in the P&L account, in the account called provision. Now that we are through, we can close the accounts now. We can now close the account. Already we had closed the asset account of the plant. Now we carry down the balance of the provision. What will go to the balance sheet as they accumulated by the end of this year. So this side, that is 0, 5, 1. If I remove 3, that leaves me with 147 million. That leaves me with 147 million. Good. So it was a bit involving in terms of determination of the gain or loss. Those steps had to be remembered. Those steps had to be remembered. Step 1, transfer the cost price. Step 2, transfer the accumulated depreciation. Step 3, record the cash received on disposal. Step 4, get the balance in the disposal account to be the gain or loss. And finally, once you're through with those 4 steps, don't forget that you must depreciate the one still remaining. Good. That's note number whatever. So let's go back and check any other workings that we can do now. We are through with note number 4. We are through with note number 4. Yes. We have also applied note 5. So I don't have any workings to do for note 5. We don't have any workings to do for note 5. No. We have applied note 4 and 5 at the same time. Now I can go to number 6. Now I can go to number 6. Now I can go to number 6. So finish. I want to talk about something there because I told you yesterday there is an accounting standard that covers that note 6. So finish. I want to go to that note number 6. So finish. I want to go to that note number 6 about investment property. So I want to talk about it before we go back. Listen, I want to talk about investment property before we go back and look at what the question is testing about it. We need to know what is an investment property and how are you required to treat it. Now let me discuss it first. We have an accounting standard called IS number 14. That is an accounting standard for investment property. Don't write, let me first explain. Listen, as a company, let's assume you are a manufacturer. That's the nature of your business. But as a company, you bought a building. This building, you are not using it for production purposes. You are not using it to run your normal business of manufacturing. But as a company, you bought this building with anticipation that it will increase in value and you will sell it later and make a capital gain. Alternatively, you bought this building so that you can be earning rental income. Remember, I have said you are a manufacturer. Your business is not rentals. Your business is manufacturing. But you decided to buy or to invest in this building so that this building will be giving you some rental income. Such kind of an asset is classified as an investment property. I have looked at it from two sides. You bought a building with anticipation of capital appreciation in value, or you are using that investment property to generate rental income. That kind of an asset is classified as an investment property. Now, let us assume that you bought that building for 400 million. That's how much you bought it for at the beginning of this year. Listen, this IS number 40 says there are two ways in which you can treat such an investment property in your books. In other words, it gives you two models you can choose from. One way is to maintain that investment property at cost. So you bought it for 400 million. Fine. Maintain it at cost at the end of the year. The second way in which you can treat that property, investment property, is by end of the year, you can value it at what we call fair value. Now listen, if you as a company, you choose the cost model as a way of treating your investment property, then listen, it means by end of every year, you will take that investment property and you depreciate it as normal. Depreciate it as normal. If the useful life of these investment property is 40 years, then it means every year you will be depreciating that building by 10 million. So by end of the year one, it will have a book value of 390. The other year, it will have a book value of 380. That way, that way. That is what we call the cost model, where you depreciate it like any other fixed asset, and you depreciate it over its useful life. That is the cost model. Alternatively, as a company, you can choose another model we call fair value model, whereby in your balance sheet by end of this year, you can value our investment property at its fair value, at its market value. Fair value is the same as market value. So if by the end of this year, the market value or the fair value of this investment property of yours, which we are giving an example as a building, maybe it had a market value of for 20 million. So you take it to your balance sheet at 420. Listen, the change in fair value, you bought it at 400, it has a fair value or a market value of 420 at the end of the year. That change in fair value, either being a gain or loss, that gain or loss now goes to the profit and loss. Now goes to the profit and loss account. Good. That is the treatment if you use the fair value model. I have said, when you have an investment property, what it is first. It is that asset which is held with an aim of generating rental income or for capital appreciation in value. Then I've said, investment properties can be valued using any one of the following models. 1, the cost model. 2, fair value model. Then I've said, if you are using the cost model, then the asset should be depreciated like any other fixed asset over its useful life. If you are using the fair value model, then the asset should be valued at its fair value at the end of each year. Then the change that will be there in the fair value, being either gain or loss, will be taken to the profit and loss. Will be taken to the profit and loss. So let's put down that information first, because we need that summary not only for this question, but even for some theory questions that you may be asked. Because sometimes you're asked, state 2 methods of treating investment property as a theory question. Sawa. So before we go back to the question and ask what are they testing as per this question, let's put down this. So maybe as part of your notes, Bado, as part of your workings, just write there IS 40. Ama unaweza andika investment property IS 40. Unaweza anza na investment property IS 40. Investment property IS number 40. And you say this, an investment property is an asset. An investment property is an asset which is held. An investment property is an asset which is held either to generate rental income, or it is held for capital appreciation in value, or it is held for capital appreciation in value. Okay, another paragraph. Investment property should be valued in any one of the following ways. Investment property should be valued in any one of the following ways. In any one of the following ways. Number one, cost model. Number one, cost model. Number one, cost model. Cost model. Then you say this. For this method, the asset is depreciated. The asset is depreciated over its useful life. The asset is depreciated over its useful life. The asset is depreciated over its useful life and shown in the balance sheet, and shown in the balance sheet, and shown in the balance sheet at its net book value, and shown in the balance sheet at its net book value, at its net book value. Okay. Number two, fair value model. Fair value model. Fair value model. Fair value model. Then you say this. In this method, the asset should be measured. The asset should be measured at its fair value. The asset should be measured at its fair value. And the change in fair value, and the change in fair value, and the change in fair value should be, and the change in fair value should be taken to, and the change in fair value should be taken to the profit or loss. And the change in fair value should be taken to the profit or loss. Yeah, impairment hatujamaliza. I know we shall deal with it. Don't mind. We have not through with the question yet. I know we have not finished the question yet. So don't mind about note 4. We are still to finish it. Bado hatujamaliza. Bado hatujamaliza. We shall discuss it still. Good. Okay, so I was saying, under this method, the asset should be valued at its fair value, and the change in fair value should be taken to the profit or loss, to the profit or loss, or to the profit and loss. You can put it that way, to the profit and loss. Okay, now let's go back to the question. What is it about theirs that they are saying? These guys are saying what? Read note number 6. Number 6 says, Dollar Limited values investment property at fair value. The fair value of the investment property is, the fair value of the investment property as at 31st of December 2014 was 586 million. If you look at the trial balance, what was the value at the beginning? So let's roll the question. Down there in the trial balance, I can see that the investment property was having a value of 548 million. 548 million. But then note number 7 says, note number 6 says that it was valued at its fair value. That's the model they have chosen, fair value. Then they are saying the fair value of the investment property is 486 million. So there is obvious a gain on revaluation. So put it down as a working gain on revaluation of investment property. Andika somewhere, gain on revaluation of investment property. Gain on revaluation of investment property. Then we are told that it was valued for how much? Let's put down that working. It was valued at 586 million. If I'm right, let me confirm. Yes, that note number 6. Then I get the original book value, 548. 548. So what becomes the gain that we take to the profit and loss? That is 586 minus 548. That looks like exactly 38 million. Good. 38 million. Sawa. That is note number 6. Number 7. Number 7 affects wamesema during the year the company made a 1-for-3 bonus issue capitalizing general reserve. That of course normally affects the statement of changes in equity. That does not affect P&L, and we are doing the workings for the purpose of the P&L. Now listen. It's like we are through with the workings for the purpose of the P&L, but not yet. Listen, I told you, when you are required to do an income statement for publication purposes, there are some rules. 1, we said you bring in your sales, whatever it is. Bring in your cost of sales, whatever it is. I told you, for cost of sales, listen, for cost of sales, don't show the workings on the face of the income statement like you used to do in section 1. No. I told you this figure for cost of sales, work it out somewhere. Bring it as a single amount. That's what we said. Meaning it's a working we have to do. Then we shall get the GP. Then I told you, you minus the expenses again. For those expenses, I told you last time that those expenses should be classified according to their function. We said starting with admin expenses, where I told you combine all your admin expenses somewhere as a working. Combine it somewhere and bring it as a single amount. That's what we said. Meaning, again, it's a working that we must do to determine what is it that we are going to charge as the total amount for admin. You remember, even from the additional information, somewhere we were told depreciation blah 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 of this is considered as a cost of sales, this is considered as admin, which means they still have expenses they have not classified yet. We must classify all of them. Then from there, we said you come to selling and distribution expenses. Again, we said get one amount for all of them. In other words, get it as a total somewhere. Bring it as a single amount. Once you do that, you remember we said you now get what we call profit from operations. So what I'm trying to say is this: when you are doing the income statement, you need to do the workings for the cost of sales, you need to do the workings somewhere for the admin expenses, and you need to do the workings for distribution expenses. We can't finish the workings now with the time remaining, so what we shall do is to stop there so that next time we shall start again from the trial balance, identifying these expenses, admin, distribution, whatever, cost of sales, and we work out the figures for them that will come finally to the income statement. That will take a bit of time to do that calculation, because we must get the true cost of sales, we must get the true admin expenses as a single amount, we must get the distribution expenses as a single amount. But for now, we can stop there. We pick it up from there next time. We pick it up from there next time. Okay. Now, just like yesterday, there are some of you who are new to this group. Today, again, was a free class. I think it will be almost the last one. I think it will be almost the last one. So if you are in this group, and you are new and you wish to continue with us, then you can call me on this number 0722 658875. If you are new in this group and you want to continue with us, then you can call me on those numbers. Our classes for FR are always on Tuesday, Thursday, and Friday. All of them from 8 p.m. to 10 p.m. All of them from 8 p.m. to 10 p.m. That is it. The charges are 4,000, but we accept installments. Just call me, we shall talk. If you are new in this group and you would wish to continue with us, okay? So maybe for now we can stop there. We pick it up from there next time. Otherwise, we have done the major workings. What is now remaining is just figure cost of sales, admin, distribution, then we do income statement, then we do the statement of changes in equity and the balance sheet. I think we should be able to finish the question next time. Okay. Good night. Okay, so for those who are new and they would wish to call, you can call after this. Immediately after this, you can call. If you wish to continue with us for the class. Yes. Okay, good night. Welcome. Call me Hilary. You can call me Hilary, no problem. Good lesson. Thank you. That is Kenneth. Thank you. If you want to continue, you can call. We can talk on how to pay. That's not a problem. Okay, good night, everybody now. Good night. Good night. I hope the sound was clear now after the hitch at the beginning. Is the sound clear? Let me know, by the way. Is it loud and clear? Is the sound loud and clear? I didn't ask you. Is the sound loud and clear? Is the sound loud and clear? I hope the sound was loud and clear. I hope the sound was loud and clear. Okay. So good night. Very clear, thank you. Very clear. And audible enough, thank you. Okay, bye.